Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I am delighted again to be able to speak to Gervais Williams of Premier Miton, one of the UK's most successful small and mid-cap investors. So welcome, Gervais.
Good morning.
Well, it's great to talk to you again. Now, after the sort of like the sharp sell-off on Friday, what's your initial take on Omicron and how that might sort of pan out with equities going forward and valuations, etc.?
Well, I think we have to set it in the context of the market, which has already performed very strongly. A lot of stocks have performed risen during the year. Valuations in many cases are quite close to perfection. So the market's a little bit vulnerable. I'm more worried about some of the sort of how it'll overlay with some of the longer term features I'm worried about. For example, we don't know, but China could be moving to a period where the problems are structural and maybe it won't grow so well going forward. Valuations of assets of all kinds, not just equities, but bonds and other things, are already at such low yields in terms of the bond valuations that one fears there's not much more to be had. So I do think the market momentum will run out in due course. Will it be made worse by this pandemic? I don't think this will make a big difference, but obviously we'll all find out in the next few weeks.
And are you sort of like viewing the sort of when you put all that together, you view it as a buying opportunity or just a wait and see, or taking a bit of profit off the table because your portfolio's done very well this year?
Yeah, I think actually that the kind of extreme valuation of some of the very high growth stocks and perhaps the rather overlooked nature of many of the other companies, and particularly UK equities and most particularly small quoted companies in the UK, I think are extraordinary. And so if anything, yes, I mean, I would argue the bottom end of the market, the small caps, it's a buying opportunity because some of these stocks are standing on low valuations already. And with a bit of a stuffing in the last day or so, perhaps they're cheaper again. It's an amazing opportunity for picking out individual stocks with upside. Yeah,
well, I have actually seen that through some of the recent IPOs and the placings, you have been putting a bit of money to work. And one stock which actually just listed only in the last couple of weeks is Eneraqua Technologies. Do you want to take us through that thesis? Because it seems to be sort of like a really good play on net zero in the UK.
Yeah, what's interesting is I think that the UK fund management industry as a whole is quite good at finding companies which aren't just well positioned for improvement, but particularly those which are well placed for climate change. And I think the UK will become more dominant in actually finding companies which are dealing with climate change. So Eneraqua, it's a company involved effectively in helping local authorities, councils and such like to actually install low carbon heating. And that's basically based upon ground heat. They drill a big 50-meter sort of well in your garden. They take the heat from underground, which is warmer than the outside when it's snowing, as today. So from that point of view, you can get the heat and you can just obviously ship it around the different flats. It's quite an involved process. It's quite an expensive process. But they are quite well organised in terms of getting the grants from the government, helping the local authorities fill in the right grant forms and get the funding. And if they help with the funding, then they're often in a good position to help with the actual installing of the product. So we're quite excited by this because we think this is going to be quite a long trend. It's only just beginning, and we think that this company is one of the leading companies in the sector. Most particularly, it's got many of the machines which need to drill those 50-meter boreholes, which are actually in short supply in the UK at the moment.
And is that the actual IPR? Because I mean, I did actually just down before we chatted. I did download the AIM prospectus, and the margins of this business, I would have thought from sort of like helping the government would be low, but actually they're 20% plus. They're absolutely terrific. So they must have something quite unique there, I would have thought.
Well, as I say, there's a real shortage of these borehole
right.
As a start for 10, but most particularly it's not always easy to put into flats warm water. It's not as hot as the heating water normally, so you need to put in specific radiators. It's quite a technical thing, and they do tend to get very good margins, which is why they're very profitable and why we expect their growth to be quite driven by not just turnover growth, but particularly substantial profit growth over time.
Yeah, well, I'd say I'd point investors have a look at that, because I've only just sort of like cast my eye over it. ETP is the ticker, but it's only trading on a sort of, well, for its growth, it's on about, I think, 21 times forward PE, so pretty reasonable. Now, another one which has got breakthrough technology that listed is Saietta, which does axial flux electric motors. And I do have a story. Apparently, you met Vic Kist out at his place in Oxford, And you were on one of his platforms, sort of like electronic vehicles, weren't you? Sort of like testing and kicking the tires.
Well, it's good to go and see the companies, of course, and
Yeah.
it is actually operating out of a former US naval base, which actually is nuclear protected. So they happen to operate in one of the nuclear bunkers, bizarrely. Obviously, very little is going to change them. But most particularly, yes, it's an electric motor manufacturer. There are plenty of them. But most particularly, we think it's an unusually efficient one, and most particularly appropriate for a lot of the Indian mopeds. As you know, India has a real problem with smog in the cities, not just pollution from CO2, but smog. And so they're dealing with all 7 of the potential Indian moped companies. That would obviously allow them to move towards electric motors in their mopeds, and obviously massively reduce their smog. I mean, what's interesting, a bit like Eneraqua, the share price went nowhere at the time of placing. And it's only more recently, the last few months, the share price has started to appreciate. And then more recently, they've actually made a major acquisition of eTract, which actually was also acquired from a distressed seller. In fact, Evergrande, the Chinese company which is involved in struggling to pay for its debt, actually owned this business in Holland, and that allows them to extend their products not just to motors, but now to drive chains in buses and such like. It looks as though they've bought that acquisition extraordinarily cheaply.
Yeah, and I think they've also got outboard electric motors, haven't they? And they've got lots of sort of different irons and fires. And also, I'd point investors that there's a lot of M&A going off in this area, because Mercedes took out one of their sort of like another axial flux electric motor, Yassa. And I think the other week ago, I think Renault invested 21% in a local French one. So there's lots of M&A going off.
Yes, I mean, I think there's quite a fast-moving sector. Of course, the market cap has come up. It's about 220 million market cap at the moment.
Yeah. Another one in the sort of automotive sector, which has sort of like been through the mill of sort of like the last few years, is Autins, and had a placing just recently at sort of 20p, raising £3 million. And I know you've supported that company freely through thick and thin. How do you see that going forward?
Yes, it's interesting. So, I mean, this is the overlooked nature of companies. Here's a company which is doing 20 million plus of turnover, not just in motor products, it does flooring as well. But most particularly, its market capitalization is less than 10 million. Yes, and that's because they've had a tough time. You know, when motor manufacturers haven't been making quite so many cars, their Neptune project, which is their main their technical product they supply to a lot of the motor manufacturers, they've had some slowdown in orders on that side of thing. They need the working capital. We're happy to support working capital, but as I say, the valuation appears very overlooked. And it's, you know, if it gets it right, and we think the products are very exciting over the long term, then of course the valuation can move up considerably from here. It's very, very overlooked.
And what's the sort of the pricing power, the USP for sort of, I know it does insulation and, well, thermal and sound insulation for cars, doesn't it?
Well, that's right. I mean, clearly, as you as cars get more sophisticated, we get more, you know, our expectations get higher, and it's a question of the weight. So it's not just a case of having things which are insulating. You want things which are very light and insulating, and they believe their Neptune product is very well positioned for that. Certainly, judging by the number of car companies which have signed up and agreed to use the product, it does seem to be technically quite strong in its area.
Good. And then we had another one which is IPO'd. I think it was over in the summer, Lord's Trading or Group Trading, which does I think it does stuff for kitchen, for bathroom fittings and stuff like, oh, is it plumbers or something like that? Yeah, building and plumbing and DIY for local tradesmen. Do you want to take us through? Is it a bit of a buy and build stroke, sort of, you know, high growth business?
Yes, I mean, what it's involved is it's a builder's merchant, traditional builder's merchant, mainly North London. But what we particularly look for isn't just companies which have a market position, but are very strong in terms of delivering for their customers, and most particularly are very closely aligned to helping their staff at the front line actually deliver very outstanding service. If you've got margin pressure, then it's great to have outstanding service. So we think that Lord's Trading Group is particularly well positioned in that regard. They've done very well in terms of retaining their lorry drivers, which is important in this industry at a time when lorry drivers are a premium. And they've actually taken market share from many others who are struggling to deliver. So it's lovely to see it come to market. It hasn't gone up a long way yet, but it's again, it's doing sales of over 250 million of sales for a company which has only just come to market. And we can see that actually having it quite a long way further to go, because it's just likely just to take market share from some of the competitors due to its long trading history, its very strong customer relationships, and of course its excellent staff engagement.
And then just sort of that sector, big picture wise, we've had obviously an unprecedented period of lockdown where everybody has been doing DIY at home and putting in sort of kitchens, bathrooms and outbuildings and roofs and all this sort of stuff. How do you see that whole sort of DIY sector going forward? Because obviously it must have pulled through some demand, or is this really just really taking more market share story?
Well, I think there will be quite good demand generally for construction, not just obviously internal DIY. This company, of course, if you want to go buy your kitchen there, I'm sure they'll help you. But basically, it's more for the professional end of the market.
Yeah, okay.
And that's an area where we believe, I mean, if you're trying to get a builder, you probably have to wait a year at the moment. So there's a huge backlog anyway. But much more importantly, with overlays like HS2 and such like, there's going to be so much demand in this area. We think that, they can supply some of the people who are supplying some of those contractors as well. So overall, we're pretty excited by the overall sector and the prospects for more capex in infrastructure generally.
Yeah, I think you're absolutely spot on with infrastructure. I did see some stat from the Office of National Statistics saying the indexed infrastructure spend over the last sort of 6 months is about 140. It's about 40% higher than it was pre-pandemic. It's just absolutely rocketed, largely on the back, I guess, of HS2. And then coming on to sort of another one which has raised some money it's a professional services firm, K3 Capital, which I think is sort of like is it a boutique sort of like, say, professional service, M&A, sort of like corporate finance business?
Yes, it is in corporate finance, but it's not as you would expect. It's not like Rothschilds or something. It's involved in the very smallest companies. If you're selling a £10 million business, right, you want to go to the top end of the market. So they're fixed price. They tend to work with a lawyer with fixed price. So they tend to get it across the line. They are market leader in their market. But most particularly, the great advantage is being quoted. They can acquire assets in ancillary sectors, R&D credits and such like. And what's been interesting is last year, i.e. last July, they used the ability of raising capital to raise capital at a time when the acquisitions were less expensive for obvious reasons during the pandemic. And that meant that actually the cash payback on those acquisitions has been sensational. They described the acquisitions at the time as transformational. And what's been interesting is it has been transformational in terms of share price and earnings, but it's also been transformational in terms of cash. So the company's been in an unusual position where it's actually forecasting its dividend, not just for this year, but even for next year. And that's through to, June 23. And that's about 15.5 pence of dividends they're forecasting against the fundraising last July of £1.50. In other words, a yield of over 10%.
Yeah. We
love companies which are not just strong in terms of, customer service, engagement of their staff, but cash generation and extra cash generation, which is one of the advantages of being listed in the first place.
Gotcha. And then what sort of the drivers behind sort of professional services and legal services going? Is it really a reopening play? Is that sort of like, because obviously we've had a pandemic and people have been working from home, and certainly the first 6 months, it must have created a big backlog of sort of like whether it's tax cases, sort of whether it's M&A, etc. And that sort of, is that really got to still really play through?
Well, I think what's happened is that we've really had a big shake-up, with all of this pandemic, and effectively that's meant some businesses, family businesses in particular, probably have thought, well, if we get an opportunity, this is probably a good time to hang up our boots and move on. So I think there's quite a lot of businesses which are looking to change hands from that point of view. I think there's also the opportunity for those companies to raise cash because clearly interest rates are very low, borrowing costs are very low, quoted companies themselves can raise capital. So actually there's quite a good mix of capital supply and companies, moving on. So I think that's meant that their business is pretty strong. Clearly, as I say, they've extended the range of services. They do go sort of forensic investigations, all that kind of stuff, but that's very small at this stage.
Yeah. Another one in that sort of like the sector, which does sort of like dispute resolution, is RBG, or the old Rosenblatt. Do you want to take us through that one? Because that must be seeing presumably the backlog, sort of like, enormous backlog of sort of dispute resolution cases, I guess.
Well, that's right. Corporate litigation obviously has become more busy over the period. Not surprisingly, they made the acquisition of Memory Crystal, which has allowed them to extend their legal services.
Yeah.
But actually, interesting enough, they've got a company called Kovex, which is quite similar in part to the K3 Capital business. It does advise companies in changing hands and all that kind of thing. It's had a slow period last year. It's picked up enormously this year, and that's been pretty strong. And they actually also fund various litigations as well, the Lionfish subsidiary they have. So basically, yes, it is a recovery stock. Like many others, it's very overlooked. As those profits and cash come through, as the dividends grow, we expect the valuation of that to rise considerably in time.
Yeah, and I guess it's also got pricing power, hasn't it? If it's got strong positions and stuff like that in its sectors, then if it has it, I mean, I suppose it's not really sort of like that dependent either on rising wages, because it's more of the professional end, isn't it? I guess.
Yeah, I mean, they do. I mean, I think all companies are going to have the cost of wages coming up quite a bit, actually. So I think that's happening in the legal profession, but it's happening particularly in many of the lower skilled markets where there's a real shortage of labour. And of course, the national wages also increase considerably. So we think the costs of labour generally are going to be a much more significant feature going forward. That's going to put pressure on all companies to generate a margin, because they'll be under margin pressure. And only those which deliver outstanding service rather than good service, hopefully will hold on to their margins.
I haven't seen it yet in financial services, Gervais. I'm looking forward to that for 2022.
There has been quite a lot of funds which have, fund managers who've said, well, they're struggling to get the margins they used to get.
Yeah, you're right.
Kind of thing.
I said it tongue in cheek.
Yeah.
Just on a couple of the sort of the stocks you've got. I mean, they're really cheap as chips. Is Mears, which does sort of like services, I think, for affordable housing, particularly for, say, the government, etc. And if I don't really remember rightly, they look after a lot of the big defence or military defence properties and stuff like that.
That's right.
Do you want to take us through sort of Mears? Because I mean, again,
it's a decent sized company. It does over 800 million of turnover, so that's a really strong business. A company which has had a very consistent management team. The chief exec's been in place for over 10 years. Most particularly, what we really like about it isn't just that they've got a great culture of looking after customers and engaging their staff, but they've been able to keep that going at a time when it's been pretty difficult with COVID, because they're in there to repair, perhaps a leak in the roof or perhaps problems with the foundations or something where they're getting damp coming through, and that's been quite difficult with COVID. It's not been as busy as you would like, because clearly they've only had to do the emergency stuff. They can't do the regular stuff. So turnover's been under pressure. They haven't done quite as much turnover as you would expect previously, perhaps 2 or 3 years ago. So the turnover's come down, the company's come down, its share price, but my goodness, is it well positioned for the future. Many of the local authorities, particularly quite a lot of the housing associations, have had less good service from some of their competitors. And so they have been asking Mears, would you mind actually taking on more work? And Mears can take on extra work, but they've only got a limited amount of staff. They can only recruit a certain amount of staff. So they've got to a stage where they're saying to many of the new customers, which they haven't dealt with before, would you mind standing in a queue? Because actually we've got as much business as we can get on with and deliver outstanding services as well. So that's an incredibly strong position. It means that there's very little margin pressure. It means they've got ongoing growth, and many times this is a company which is still only valued at about a P of 10.2 times.
Yeah, I know, you're right. Yeah, I was just looking at
2021, and most particularly, it's a company which already has it's moving back onto the yield, so it's probably got a prospective yield of something like 4, according to the analyst forecast. Could be more going forward. So here's a company, very overlooked, decent sized business, right, with good and growing income. It's just the perfect investment for a very stable return at a time when the world's very unstable in itself.
And how's the management team going to? I know it did say it wants to improve its margins, increase its margins, because it's about sort of 3 or 4% operating profit margins. Is that going to be putting in the sort of, as it upgrades some of the public sector sort of housing with, I don't know, with net zero stuff and energy efficiency and all that kind of stuff?
Well, Eneraqua, of course, will be involved in that as well. But most particularly, they've got more work than they can shake a stick at the moment. So that's not just the emergency repairs. Obviously, some of the planned maintenance needs to be done as well, and that's been held up for the last couple of years. So they're in a great position just to carry on doing the work they're already doing, quite apart from putting in, low carbon heating and all of those other things which they may need to do in due course.
Yeah, another one, 2 others actually, which are in the oil and gas space, which again are I've never really sort of come across them. Independent oil and gas, that's IOG. Do you want to start with that one, because it's sort of like it owns gas assets, I think, in the North Sea. But again, I mean, the gas price is obviously really strong, isn't it, at the moment?
Yeah, so what's interesting is, people sometimes say, well, hang on a minute, should we be investing in oil and gas assets? Should we bring them onshore? And I think, it's not like you can just suddenly turn all the filling stations off and just say, electric cars are here, we're wonderful. It does take a period of transition. And I think sometimes we've been a bit too abrupt in that transition. And I think that's why the gas price is as high as it is in Europe. So this is a company which came in 2 years ago, took an old gas line coming into the west coast, sorry, the east coast of East Anglia, and it's now drilled out with some low carbon drilling, some various gas wells, which it's going to bring on stream. It's not on stream yet. It's due to come on stream either at the end of this year or beginning of January. But most particularly, it's invested £300 million in this area. For a little company like this, it's amazing. They've got one of the Buffett has actually come alongside. One of the vehicles which Buffett invested in is also investing half alongside them.
Warren Buffett.
Yeah, exactly. So it's incredible, and most particularly because they've been so sensitive to climate change, their new kind of gas coming on stream in a per barrel basis involves something like 0.6 kilograms of CO2 being emitted for every oil barrel equivalent that they produce. Well, when you compare that with liquid petroleum, which is gas which is imported, it involves so much energy to kind of compress it and get it in the right form and ship it around the world. They're talking about 300 kilograms per barrel of oil. So this is, this is offshore, coming onshore, using old equipment, and because it's so well organized, they've got a very, very low carbon footprint compared with the alternatives. And I think that is the way forward, to be honest.
Yeah, I mean, certainly gas has got to play a part, hasn't it, in that sort of like the step between going fully green and coming off, sort of carbon. I mean, if we're actually turning on coal-fired power stations because we have to, it just says everything, doesn't it?
It really does. Although I was listening to the BBC and they said that was possibly a fake tweet or something. I don't know if it's true or not.
Oh, I see. Okay.
Yeah. But anyway, yes. But I mean, we've got another one alongside, which I think you might be.
Jadestone.
Yeah. So Jadestone is a slightly bigger company. It's capitalized at $500 million. It's quoted in the UK. I only use dollars because it's obviously it's an oil company. But what's interesting again is they took an old field, an offshore field north of Australia. And it was probably had an overhead which was large, which meant it was unviable. But with their lower overhead and improved safety standards, I hasten to add, they've actually been able to extend the life of this field, which means you can keep the energy coming out in terms of carbon without necessarily putting an awful lot of CO2 into the atmosphere to drill new wells. And that's got to be the right way forward. They've got a couple of new opportunities where they're going to take on assets again, one in New Zealand, one in Vietnam. But most particularly, it's generating a lot of cash. It'll generate a lot more cash next year as a lot of its new wells come on stream because it's extended the area of its operations slightly. But most particularly, that's perfect. Generates plenty of surplus cash at a time when we are uncertain about what's going to happen regarding oil price and energy prices. We haven't been, generally the majors haven't been investing in much oil and gas since 2014. So I think there's a shortfall of new assets coming on stream, and we think Jadestone are well positioned for that recovery.
Yeah. Well, it's quite interesting actually, because I have heard from other companies. Australia's got to this situation. It's a big producer of oil and gas, well, particularly gas, but it's sold everything to the Chinese, and so it's become a political issue that it needs to produce. Make sure it produces enough for its own domestic market, which doesn't want to have to start importing. So I think Jadestone is going to be well placed for that. And then you've got a couple of other sort of like good sort of recovery stocks, I guess. Do you take us through Tech because. I think that does sort of like public sector, digital IT sort of data sort of services. Sort of
actually, Maytech's held by some of the other funds. It's not held by our.
Oh, sorry. Okay, all right. Well, what about Cyanconnode?
So Cyanconnode is again. What's interesting is so many of these little companies. They're quoted. They've been quoted for many years. And drip, they just gradually make progress. And then they get to quite a tipping point where suddenly all of that spade work starts to mature, and then they accelerate and generate a very big cash payback. And that's the kind of prospect we're trying to pick out. We believe Cyanconnode is at that tipping point. It's no guarantee, of course, but most particularly, they've been moving in the Indian market where they've been helping address the kind of measuring of usage, particularly of electricity, but other products as well. So it's involved in in utility measurement, but it uses a technology which means that generally it doesn't matter if the mobile phone network isn't their area, they can still provide
this is the RF mesh technology, which
that's
is their
right.
own.
They were claimed to be the world leader in RF mesh technology,
yeah.
And most particularly, they've got a lot of installed, meters which demonstrate for the Indian government they are working. As you know, the government in India is now actually looking to roll out a directly metered electricity use for all of India over the next 4 years, and they're very well positioned to participate in that. They won't do it all, they might even do the majority, they might do a small part of it, but that would make massive difference to the history. And most particularly from my point of view, when you meet the company, they've got all of that history of successfully delivering in a market before it became exciting. Now it's exciting, they should be able to scale up quite considerably.
And what's the sort of the advantage of RF mesh technology compared to sort of cellular? Is it sort of security and sort of like, it's perfectly suited to measuring smart meters and stuff like that? Is that an M2M communications? Is that sort of like this?
It's mainly related to the peer-to-peer. So if you have a range of different premises and you're measuring it, you can pass the message up the line so that you don't need to have a mobile network to pick up the data. It can be passed up the line to perhaps a house way up the road or perhaps way up the valley where they actually have got mobile technology, and then it can take all the data from that corner. So it's effectively really excellent in areas which are difficult for mobile signals, or perhaps emerging markets where they don't have mobile signals everywhere. But initially, if they also, the Cyanconnode business, which they acquired a few years ago, actually works in Sweden and Norway up and down the fields. So actually, they also got this kind of quite long distance thing where they can fire the data across quite long distances. Okay. So it's not just about the network and the mesh, the RF mesh. It's also about the ability to bring it back over quite long distances if they need to, back to base. And it's most particularly to get data continuously. It's not, you can't just kind of measure them once a month or something. It's much better to have much quicker data. So you can tell as a supplier whether the energy you're putting in is being measured in full when it's coming out of different areas, or whether there's something gone wrong, or perhaps there's something going on which is shorting or something. But it means it's a much safer and a much more secure system for the utility. They tend to get more cash return as a result of that, and they tend to have less losses.
And I guess actually, if it's sort of like smart meter monitoring, also it's a sort of move, isn't it, towards net zero, isn't it, and sort of carbon reduction. Yeah.
I mean, if you're measured, for your usage, you tend to be less wasteful, and that's great news.
Yeah. Now, what's your take on Avacta's news this morning? They basically do sort of like, they do sort of, it's called the precision technology, which does sort of chemo warfare warhead, sort of like to help sort of with drugs, and obviously the Aframa diagnostic and the sort of like that platform. But what's your sort of take? Because I think the FDA decided to allow Avacta to do clinical trials in the US for their precision chemo warhead, doxorubicin.
That's right. So that they'd like to think that their Aframa technology, which is their core, mixed with some of the Tufts University data, which brings in the precision aspect, can mean that actually that if you're having chemotherapy, the chemotherapy will be much more, it'll only really attack the area which it's designed to attack rather than other parts of your body. So it means that you can have more cycles. Each cycle is hopefully less toxic, and most particularly, over time, if you have more cycles and they are less toxic and they get to you get a better outcome, especially late stage cancer. So it's a pretty exciting opportunity. When we invested back over 2 years ago before the pandemic, we were very excited by the opportunity for this therapy to become quite significant. And the reason we were confident was some of the quality of the partners we thought were very substantial. But what's been interesting, of course, is that progress has been to some extent offset by the huge growth in lateral flow tests. They've got their own lateral flow tests. We're still waiting for news about where it's going to be sold or the rest of it. It's taken a while to get to the finishing post, but the data looks very accurate in terms of it hopefully picks out those people who are infectious for COVID, but most particularly doesn't have many false positives, which is also tremendously important. So we'd like to hear some more news on that. But from this point of view, this is just yet more evidence that their therapeutic platform is a very strong platform. It's been endorsed effectively for trials by the US, which is obviously quite a high bar, and would, in our view, sort of give another indication of just how strong their foundation, their therapeutic foundation is.
Yeah, and I know they commenced first patient dosing in the UK of prodoxorubicin, I think, in August. So they've already been running that trial for just over 3 months now. And what's certainly interesting to me is actually if there was any negative news coming out of that, the Avacta board wouldn't have actually progressed their application with the FDA to start up clinical trials of the same.
I think that's a
drug in the
tremendously
US.
important point. I mean,
Yeah.
I think bad news comes early in trials.
Yes.
So fingers crossed, and I'm touching wood here. We haven't had any announcements regarding any bad news, so that's reassuring. As you say, specifically, they've gone forward with their US application, and it's been approved, and they'll have a lot more detail than we have. So from that point of view, all of that is reassuring that it's all not just attractive, but it could be a major foundation for dealing with chemotherapy in the future.
Yeah, I think they've got first, is it PK data coming out in the next month or so with a bit of luck?
That's right, early next year. I think we will get some early data on the first, and this is toxicology trials, of course. So it's mainly about whether it's toxic, but it also is involved in people who are late stage, who obviously have tried other treatments, perhaps which haven't worked. So there may be some news on how well those patients have got on as well.
Yeah, and I think with their lateral flow, as you talked about, I think what's sort of like quite frustrating actually is the UK government spent a lot of time and money and energy building up the UK industry. I mean, there's other companies like Omega Diagnostics and stuff like its own sort of like flagship manufacturing facilities, and they've decided not to. We haven't put any contracts. I mean, my wife works at a local school, and she's got 3 boxes of lateral flow tests, all from Flowtex. I mean, or Flowflex, I think it's called. I mean,
that's right. They're a Chinese company, I think. I mean, it is. I think they must have had an early contract, and they must have just sort of scooped the pool. I would like to think that in due course, the UK government can buy also some trials from local suppliers as well. But we'll see what happens. The main thing is we all need more lateral flow tests. Not just your wife, but everyone, and it's going to be a kind of quite a perennial aspect. And I hope that Avacta is part of that solution along the way.
Yeah. And anyway, they've got lots of sort of shots on goals with the AFAMA platform and the precision platform, where a lot of the real value lies anyway. So another one which is doing sort of breakthrough technology, but in advertising, is Mirriad Advertising, which again are sort of like I think it's got sort of like unique in content sort of programmatic advertising technology.
That's right. I mean, this is a company which we've had from an early stage. It's still quite an early stage. It's still got quite small sales, only a few million. But most particularly, they've got some very high-profile executives which are bringing in some of the very highest-profile businesses alongside them, and it's a way of helping brands become more visible. We don't tend to watch telly in the same way as we used to. The advert breaks where we'll go off. We don't watch that either. So from the point of view of advertising, it's getting harder. And if you can put your image in the middle of a film or perhaps a sporting event or whatever, at that stage, it means actually that you get the profile without people feeling that they have to kind of stop and listen to the adverts. So from that point of view, it's quite an exciting concept. The valuation of the company has come quite a long way. It's now over 80 million. So it's quite a decent market cap. It's quite a lot of expectation in the share price. We've got a very small holding, to be fair, because it's come up such a long way. But most particularly, isn't it wonderful that we can have quoted companies which can bring breakthrough technologies, get support? That's what quoted companies should be about. And a myriad of, we'll still find out whether they get the big sales, but they've already, got the support in terms of cash to get to the finishing post.
Well, what we should do is we should revisit it in 6 months' time and have an advert going through on the back of our over-the-top video, because that would be perfect, wouldn't it? So, like, just talking about the relevant firms.
Well, it might be an advert from Fox Markets, of course.
Yeah, well, there you go. Absolutely, could be a customer too, right? Yeah. And then just sort of like finally, just sort of the any sort of risks to watch out for. You mentioned sort of the potential China with sort of like that could be slowing growth, probably largely to do with things like Evergrande and the property cycle, etc. And obviously we've got things like Omicron and other variants coming forward. Anything else to sort of like to keep the sort of?
I wouldn't be surprised if we get another cycle where valuations move up even higher. UK interest rates are still positive. German interest rates are in long-dated bonds, they're negative. It could be that UK interest rates in long-dated bonds go negative. They could go negative in the US. They could go negative in China, right? Just like they are in Japan. So there still may be an opportunity for some of the very highly valued stocks to outperform again. Nasdaq may still have another run. But ultimately, if China is moving beyond its long period of growth towards a period of it structurally challenged, a bit like Japan, if we are finding that valuations can't move up much further, and most particularly if we find that wage costs now become much more endemic as a problem, and that's absolutely what I expect to happen. I think the percentage of wages as a percentage of total costs in business are going to be much more significant going forward, irrespective of whether we get world growth or not. And I think that's going to be a real challenge for margins and earnings generally. And we're looking for companies which are able to buck those trends. Small quoted companies aren't just small, they're often younger. And being younger, they're serving immature markets. And in that regard, hopefully they've still got growth prospects, even at a time of a global recession. We saw that last year, small caps outperformed. So we think actually the UK is superbly positioned, not so much because we think the UK economy is any better than any others, not that at all, but we've got this a focus on companies which are well capitalized, often generating surplus cash, but most particularly are small and agile. And we think beyond globalization, we need more smallness. So coming back to the question, I think there's going to be a real challenge going forward. I think costs of wages are going to be a real burden for small companies as well as large companies. But I think we'll find companies which can buck the trend. And like K3 Capital, they can acquire assets from low-cost acquisitions at a time of uncertainty and make disproportionate cash payback. So from that point of view, I remain very upbeat about the potential over a number of years for small quoted companies to outperform.
Yeah, and you're looking for, presumably then in that case with higher sort of costs, you're looking for companies that can sort of like either absorb it or actually push their prices up and will have their USP, which is your fast moving sort of like the customer service side. It's that sort of like those companies that have got something different, I guess.
Well, absolutely. When I meet companies, there's very few presentations I meet, or companies I meet, which actually have a decent amount about how well they motivate and lead the staff, how many staff surveys they have. And why is that? I think that should be there, to be honest, because I think if you are good at looking after your staff and helping them to look after their customers really, really well, it's motivating, it's engaging. But most particularly when people turn up and say, I can buy it cheaper around the corner, then of course you can say, well, you can go around the corner, but the service isn't so good. So it gives you something to defend that margin. And I think that's going to be essential going forward.
Yeah, and I guess there's going to be still a hefty number of M&A, isn't there, as well, of overseas buyers looking for value in the small cap sector. So I guess the Premier Miton portfolio will probably see a few takeovers as it has over the last couple of years. Well,
we've seen a number of takeovers over the years, and again another one today with Marshall's Motors, for example. Again.
Oh, okay. I didn't realise that. I didn't see it.
Yeah. So again, it's obviously only at this stage. It's still to be confirmed. It's just the board have updated us. But basically, I don't really want companies to be taken over. I'd much rather them succeed without being taken over, because I think there's more upside in many cases over the longer term than there is in a short-term uplift due to takeover.
Brilliant. Okay, well, thanks very much for your time again, Gervais. Fantastic insights, and look forward to touching base in 6 months' time, see how the stock selections or the stock ideas have progressed. Well, thank you for the Paul, and sorry for the block nose if it comes over as a bit sort of a block nosy. I don't know what it is. Maybe some kind of I don't have a cold at the moment. It may be some kind of hay fever or something, even in the winter. Well, what I suggest maybe you want to get an Avacta lateral flow just to test it out. Well, I do regularly use that, and I fortunately I haven't had COVID up to now. Fingers crossed again. Yeah, I'm sure CEO Alistair Smith can send you a couple of boxes. Well, I'm happy to use the ones from the NHS. Yeah. But anyway, yes, you're absolutely right. Yeah. Take care. Thanks very much, Gervais. Thanks indeed, Paul. Really enjoyed it. Bye.